Hello financial investors and welcome to the channel. Today we're going to be taking a look at the M1 Finance Roth IRA platform, looking at the stock performance for this past week, what stocks paid out dividends, if we received any, also taking a look at the overall performance of the market in comparison to our portfolio. Last week was a bit of a rough week, so we're going to go ahead and take a look at how the portfolio performed here during the down market. Also, we're going to go ahead and make a stock purchase. I don't have it in mind at the moment, but what I want to go ahead and showcase today is what positions are currently negative, and I'm also going to be using Seeking Alpha to kind of see which stocks are coming up on ex-dividend here in July as we enter the 7th month of 2020. With 5 months left here in the year, there's a lot that can still happen. As we can see, the headlines here is that Asian markets overseas sharply fall with the illness cases triggering concerns for a global recovery. So that is the topic that's on everyone's mind here. Is there going to be a second wave, as we've seen over in Hong Kong with school shutdowns and all sorts of other fun stuff? So Hong Kong is currently down 1.3%. It is currently about 12, a little after 12 a.m. So Japan and England and Germany are not yet open, but they should be open here in about an hour, a little bit. So it'll be kind of interesting. Right now, stock futures were negative. There they go. They go negative once again, and they were moving negative, positive. Right now it's still after hours. Who knows what sort of media hype will get pushed out? Fed comes out, starts pumping money, new stimulus stuff. All sorts of fun stuff can happen in the day that can drive the market either positive or negative. So who really knows? So with that said, if you are brand new to my channel, have not yet subscribed, would really appreciate if you do hit that subscribe button down below. If you have any comments or questions at any time going over this video, the stock market, dividends, want to let me know what stocks you're planning on purchasing or have recently purchased, I'd be really interested to know, what are your current thoughts on your portfolio? Are you staying invested? Are you selling a little bit of your positions and taking profits, or are you continuing to dollar cost average into this market? So let me know down below, and let's go ahead and get into the video. So right off the bat, the portfolio is still positive, but we can see here that market gains have driven now this portfolio down into negative $76.01. The only thing that's really holding up this portfolio right now is the time that this portfolio has been created. This portfolio was created back on January 8th of 2018. That means that it's had a little over 2.5 years to sort of simmer and generate earned dividends of roughly $1,200. $1,206.08 of just straight paid dividends or earned dividends that are going to be paid out here in the future. So that's what's kind of giving us our market gains and recovery here in the portfolio. And over time, the earned dividends will continue to grow. Now, looking at just the 1 week performance here, we can see that the market was a bit down here on the week. So overall, the portfolio down 3.57%, which is actually a bit more than the other indexes. If we take a look at the S&P 500 here up on the screen now, we can see that the S&P only lost 2.86% this last week. The Dow Jones and the NASDAQ actually lost the least of them, down 1.9%, but the Dow Jones here down 3.3%, and that's almost in line with where I got hit here at 3.57. Now, the biggest losers this past week here were AMD Industries, down another 8.67%. I know they've been kind of getting hit these past few weeks. ABM Industries has been getting hit. Again, financials, real estate investment trust, in the retail sector are going to be getting slammed. Casinos and resorts are also going to be getting slammed. Small sort of outlets and shopping retail are going to get hit here in the short term. So we can see here that these are down towards the bottom. They were kind of hammered really hard this past week. Now, some of our gainers, very few, just a few here. Waco Group up 11.49%, Cisco Systems up 2.18%, Stanley Black & Decker up 1.75%, and of course we have Apple up 1.12%. Apple never seems to catch a week where it's just red, but this week, it didn't perform as well as as it has in the past. So it's still doing really well here for the week. And then we have Digital Realty Trust, a technology real estate investment trust. So very interesting there. As far as the activity goes for just this past week, last week was the 22nd through the 26th. So we had we did have a dividend paid out. We had Lockheed Martin paying out $4.99. I was not aware of that one. I may have just recently added it to my sheet, but I didn't actually see who paid out. And then we made our deposit here on Friday. That way we have equity available in order to make our investments here on Monday. Now, with the market being down here on Monday, that's a really good opportunity to continue to dollar cost average. I am currently in my 30s, so I have 60 years until I hit 60 when I begin to withdraw from the Roth IRA completely tax free, but I am not going to withdraw 100% of it, obviously. I'm still going to be alive, hopefully well after 60. Say I live I live to be 90. That's 30 additional years beyond where I'm able to withdraw from the Roth IRA tax free. So I really just need to kind of continue to pump more capital into this until I can, every year work on maxing it out, obviously. That leaves me with, say, 15 years in order to pump cash into this. 15 by 6, that's what I'm not sure on the calculation there. 15 by 6 is 90. So by the end of, by the age 60 or so, I should have roughly 90,000, and then my current investment there of around, we'll say 20,000. So we'd have put in around 110 to 120,000 of our own capital, which, with stock market average returns of 7 to 10%, we could see a total Roth IRA account of somewhere in the $400,000, $500,000 range, which will then pay out dividends with, that are completely tax free, where I don't have to worry about paying any capital appreciation or pay any taxes on the dividends that are paid out. And this will just be one stream of, of income. I'll have my real estate investment properties. I will have, who knows, Social Security. We'll also have other little miscellaneous things that are out there generated as cash on a month by month basis. So just Roth IRA is just one of the floating boats, one of those safety boats that you want to be inflating along your path and on your journey. That way, when you do need to use it, it's there and available. So that's enough of that. And so we did take a look at the 1 week. We had very few positions actually positive, which leaves us with some actually new positions in the negative. We can see that Essex Property Trust was positive last week, but is now negative by 3.23%. So I'm going to go ahead and adjust this like this, so we can continue to see if positions move up or down here in the short term. Now this leaves us with, we'll just say, I'll show you how many positions we have in the negative here, right by highlighting there and there. So we have 20 positions in the negative currently, as far as dollar basis to our initial cost basis of where it's currently at. Our worst position is Simon Property Group, down 61.8%, and our least negative position is down 1.29%. So quite a bit there, positive or negative. Now, of the upcoming dividend positions, this is Seeking Alpha. If you guys have not checked out Seeking Alpha, I would highly recommend going over there. Create an account completely free to sign up. I signed up as the financial investor. Once you've signed in, click on your portfolio up at the top. Actually, don't click on that. You'll want to go over here and create a portfolio. Enter in all your positions in your portfolio. I've only entered in the M1 Finance ones, but then from this point you can go ahead and click on dividends right here, and you'll have the option of adjusting these per when the ex-dividend comes up. So here, for example, we are entering the very end of June, Tuesday. Monday is the 29th. Here today is the 29th. So WP Carey, I'm going to earn dividends for that company. Essex Property Trust, I'm going to be earning dividends for WP Carey, Essex Property Trust, Realty Income, Cardinal Health. All of these positions are going to be paying me out dividends here in July, and they're going to be paying me a nice sizable dividend, but all of them because of the position there. Now, these ones, actually, Realty Income, I can actually buy more of this one prior to the ex-dividend because Tuesday is when it goes to ex-dividend, so I can actually buy it Monday, hold those new shares and have it go ex-dividend on Tuesday, where then I would get paid out those dividends. But Realty Income right now, it's up at the top. It's one of my fifth best performers, up 25.57%. So I'm not going to be adding to that one. Cardinal Health is also up here in the positive as well, right there, 6.23. So I'm not going to be adding to that one as well. ABM Industries. Here we can see ABM Industries. I know this one has been hammered here in the short term. I know the last few weeks I've seen it in the chat there getting hit, but it's still not down in the negative. It's been getting hammered, but it's still up 36.98%. Third best performing company out there in the portfolio. So even though it's had some pretty rough weeks these past weeks, it's still doing really well. So we kind of go into Cisco, and I should have, I could have had these all sort of pre-planned, but this is how I kind of go about my whole process of looking at the current positions in the portfolio. Does it make sense that I want to buy them now? So here, for example, JP Morgan is negative. I'm going to go ahead and just put an asterisk over there, a little star, and kind of showcase that that one is a company that's currently negative that I could definitely average into if I chose to, but for the time being, I think I'm going to be skipping out on JP Morgan. It's just not a company that I'm interested in. AT&T is a company I'm actually interested in and continue to average more into, especially if it's around 30 or below. And right now, AT&T is trading at $29.08. And with tomorrow being a red day, it could be another, it could be below $29. It could be in the $28 range. And I've had comments in the last videos of why am I buying AT&T? If I look at the performance of AT&T to the S&P 500, AT&T has an average return of every year of 2%. That doesn't include their dividend that they pay out of nearly 7.15% right now. So if you're just looking at capital appreciation, AT&T is not going to be the best for your buck. But AT&T, I look at AT&T as a high yield savings account or a high yield bond. AT&T, regardless of where the market really goes, it doesn't get hammered as hard as the others here. So for example, I'm going to go ahead and punch in AT&T. I'm just going to go ahead and punch in T, and what AT&T has a low of is 26.08. So here we are at $29. That leaves me with $3 of downside potential on AT&T versus upside potential of say $39.70 and a starting yield of 7.15%. If I were to compare this to a bond that's out there, ticker symbol BND, this one, this one has a low of $76.49 and a high of $89.32, which is already trading near all-time highs. Now, bonds could continue to rise, but I feel much safer in just kind of long-term investing in stocks and equities versus bonds by just buying AT&T, getting locked in at that yield, having very little downside, but having a safety sort of mechanism there with the dividend starting at a high yield of 7.15%. So I'm going to continue to just kind of buy into AT&T with little downside. I could see AT&T falling to $27, big whoop, and then I just buy more of it, and then when it does recover in the future as the total market recovers, I'll sell it off and move that equity into other positions that are more growers. So that's my whole thought process on AT&T. AbbVie here. I own quite a bit of AbbVie. I think I own around 40 or so shares on my Merrill Edge platform. Then I have some here as well. That one is still positive in all my accounts. So that one's still up there in 10%. Caterpillar. I know Caterpillar is currently down there. So Caterpillar is definitely a company I could definitely add more of. I thought it was on my stocks to buy over here, but it does not look like it made the list. That could be because it's at $800. I could definitely add more to it. It doesn't have the yield of AT&T, but I'm still going to go ahead and add that one in there. And I think that is all that I want to go ahead and take a look at, because I know that, oh, I did have a few. No, right here. Gotta go down. Okay, so right here, Caterpillar, that one's negative. Lowe's is not negative. Lowe's is up here somewhere. I guess I'm just gonna go Control F. And Lowe's, top performer there, or second best performer. Caterpillar, we know that's negative. Pfizer, where's Pfizer here? I spelled that incorrectly. Pfizer's actually negative. Pfizer's down by 12.45%. That's actually really nice. I like to see that. I really want to see Pfizer down a bit more. So actually, that leaves me with some really good positions here. So that leaves me with Pfizer, AT&T, JP Morgan, and Caterpillar. So I'm going to go ahead and take these four: Pfizer, AT&T, JP Morgan, and Caterpillar. We have all the ticker symbols entered in here. We have Pfizer, AT&T, JP Morgan, and Caterpillar. Let's go ahead and look for some warning flags with these companies. Now, right off the bat, why am I looking at these companies here? I like to look at them in the 1 year period. Take a look at where their position is at here with their price and their 200-day, 50-day moving average. Pfizer, for example, is trading below its 50-day, 200-day moving average. It also offers a starting yield of 4.62%, which is not at highs of say 5%, but very close to 5%. So if you're trying to buy the bottom, it would not be the best opportunity for Pfizer. Just kind of buy into it when it's down and gradually, dollar cost average into it, and when it does recover, your position will recover as well. But we'll kind of take a look at this one again here in just a minute to see if there's any red flags. AT&T here, $29.08. Its 200-day moving average at $35, 50-day moving average at $30.27. If it can break above that $30.27 and stay above it, it may have some upwards trend. So this is a good buying opportunity for AT&T. Anywhere below 30 is a good buying point for me. It again offers a nearly over 7% starting yield right now, which is extremely high here in the short term. So AT&T has said here recently that they're confident with continuing to grow and paying out that dividend, and I believe they may have just recently raised it by a cent. They don't raise it very hard, but again, I look at AT&T as a bond equity. JP Morgan here, there was an article floated out last week that they're looking at restricting banks paying out dividends if they cannot pass their whole rules. They have to have so much cash on hand and be able to pay out dividends, and there's a lot of those restrictions. So we could see JP Morgan, Wells Fargo, Citibank, and many others return to the 2008 period where they just kind of cut the dividend. So JP Morgan's a bit of a riskier one in the financial sector. It's not one that I really want to focus on right now in the short term, but I kind of want to showcase it anyways. So here it is at $92.59. If it does break here, remember here, it trailed all the way down. Here, spiked about above that 50-day moving period, hit had some support and just shot up over the top. Now, if you had sold up here, as you started to see some sort of resistance, that would have been a good period. And here we are back at 92.59. If this one can get back up into the $95.71 range and stay above it for a bit, we could see another spike there above $100. But again, I'm not going to be buying into this one here in the short term. It does offer a 3.78 starting yield and is generally one of the best financials as far as big banks. And if you were to compare JP Morgan, Citibank, Wells Fargo, and what's the other one? Not sure on the other one right now, but JP Morgan's usually one of the better performers here over like the last 10 years. Caterpillar here. Caterpillar not quite trading below that 50-day moving average, but it is trading below that 200-day moving average. It does have a nice starting yield of 3.37% and this one is a dividend aristocrat. So if we're looking at these four, AT&T and Caterpillar are the longest growing and paying out dividends over these companies. So here we have AT&T at 35 years. Here we have Caterpillar at 3 years. Why is that at 3? I'm pretty sure Caterpillar is going to pay out dividends for much longer. I have it on my list of 10. I thought it was longer than that as well. So maybe I was wrong. I thought Caterpillar was a long paying dividend company. So of these, we have AT&T as the only dividend aristocrat. JP Morgan and Pfizer JP Morgan's at 9 years and Pfizer is at 10 years. So Pfizer is straight behind AT&T as far as dividend growth. Another reason to just buy AT&T, right? So of these positions here, we do see quite a bit of value out there, but with value comes risk. So let's look at revenue, net income, And let's also take a look at their earnings. See if we can see all these metrics all at once without kind of breaking anything here. Yeah, it looks like this will work. Okay, so let's go ahead and look at percentages over the past 10 years. Where the company's heading. Let's see if there's any other metrics we can kind of throw in here to see and measure these really well. And I think that looks pretty good. Maybe we'll throw some price in there too, just to kind of look at the price movement over the past 10 years and what it kind of follows here. Okay, so over the past 10 years, we have Pfizer has 120% growth over the past 10 years. That's really nice. That's averaging about 12% on average per year. Revenue is in the orange. Revenue is down by 18.11%. You know, this would be something to kind of read into. Is revenue a big factor for Pfizer? You know, obviously, generally I like to look at revenue that's increasing on a yearly basis, but it's kind of interesting. McDonald's does this as well, where it has decreasing revenue, but they're increasing their net income. So here, for example, net income is up 93.85%. So maybe they're doing something where they're kind of decreasing and what's it called? Franchising is what McDonald's does. Maybe Pfizer does something on the same side of that. They're on the pharmaceutical end. So maybe they have some decrease in revenues for a reason, but they have some really nice upside in their net income. Also, look at their earnings per share here, up 59% over the past 10 years, or 5.9% on average per year. So kind of an interesting one there. If we were kind of look at the trend lines here, we would see that the price pretty much follows the net income and the earnings per share. When the earnings per share spikes up, the stock price also spikes up. When the earnings per share and net income go down, the price also comes down. So this one really doesn't go off of its revenue. Looks like a lot of investors generally look at the net income and the earnings per share. And currently, you know, I would want to read into revenue, you know, why it's down. I probably did this in the past when I started buying this company some 2 years ago. We did have a bit of hiccups back in 2018, 2019, and that's essentially when it has been starting to kind of decline there. So this one would probably need to take another look at as to why their revenue has been declining in these last few years. AT&T here, let's take a look at this company. Price change over the past 10 years, 16.55%. So that's an average return of 1.6%. But what you're not seeing here is the dividends added in here. I don't have a good way of adding the dividends in there. Maybe, let's see here, price is in the orange. Now price is showing 16.55%. So that's the same thing. So let's just take out dividends. Okay. So this does not show dividends being reinvested in there, and that would give it a slightly higher return than where it is at right now at 1.65. But also, let's go ahead and take a look at their other metrics. So revenue in the orange up 4.5% on average per year, or 45% over the last 10 years. Net income is positive at 1.7% on average per year, or 17% over the past 10 years. And in the red is their earnings per share. So this is actually kind of negative for AT&T, one of the companies out there that pay such a large dividend. What if they are not able to continue to pay out this dividend? So let's just look at their data here. They pay out roughly, I believe it's $2 and some change for dividends. And let's go ahead and jump over here. Let's see if this kind of shows us. They pay out $2.06. Their past, or they recently, let's see here. What does this show here? It says dividends, dividend rate trailing 12 months, dividend rate forward. So in the future, they're going to be increasing it. And I wish I could see their earnings. Let's check out this other website that I know, dividend.com, and punch in AT&T here. And hopefully it shows us a bit more information versus what this other one does. So here, this one pays out $2.08. That's what we had already seen. No, thank you. What we're looking for is what is their current earnings on here. Man, this website really got funky. Yeah, I don't know how to read all this. I like how it used to be in the past. Now they just kind of change it up, and it really looks terrible. But anyways, looking at AT&T again, over the past 10 years, Oh, we're not looking at percentages anymore. Again, I'm looking at it as a bond. I'm not looking at it as growth, but earnings per share being at 1.97 when they're paying out roughly $2 and some change in dividends, that could be a bit of a red flag where they're expected to pay out 204, 208 to their shareholders on a yearly basis, and here they are with their earnings per share trailing 12 months of just $1.97. So they basically have a payout ratio over 100% if this is accurate. So this will just need more research in there. But of course, I'm perfectly fine with investing in AT&T in the short term. JP Morgan here. Let's go ahead and add this one. JP Morgan looks amazingly well here. Growth 14% on average per year, or 140% over the past 10 years, and that's after this massive fall here recently. Also, if we take a look at their net income in the orange, that's 10% on average per year, a little over there. If we look at the earnings at 16% on average per year, and that's again after this massive fall here, with the Fed's been cutting rates, week after week, month after month. I'm getting emails on a weekly basis, it feels like, of interest rates being changed on these accounts, and what are they called? Mortgage rates are at all-time lows. You're getting rates at 2%, 3%, which is extremely low. It's even lower than back in 2012, 2013 period. So really interesting. That's one of the ways that these big financial institutions get a lot of their cash, is by loaning out money and having people pay it back up 5, 10% rates instead of these 2 to 3% rates. So they're getting hit here on the short term, but over the long term, this company it's a great company as far as financials go. Jumping over into Caterpillar, I didn't see any red flags with JP Morgan. It's just that dividend. If you are building a dividend portfolio, it could be a bit of a risk. Here, Caterpillar looks extremely well as well. If we're looking at price change, it has an average return of 9% per year, or 90% over the past 10 years. If you're looking at net income in the orange, massive net income, you can see it did go negative here back in 2016, maybe 2017 period, but recently picked it back up. So maybe a slow year there. Picked it back up quite hard. And then we have revenue, 5% on average per year. That's pretty nice for a company the size of Caterpillar and what they do in the sort of tractor and all the outdoor equipment. And they have earnings per share moving with the market. This is kind of interesting that the stock price doesn't follow the earnings per share. We can see earnings per share dipped during this period, so did net income. And the stock price just kind of continued to kind of mellow forward. It didn't drop with the earnings. It just kind of crept up. As earnings recovered, stock price moved higher. And here, earnings has been kind of trailing downwards. Net income has been also trailing down, or the revenue has been trailing downwards, and the price is kind of following. I think this company looks fairly solid. I don't see any risk here with their earnings. If we take away their data format here, we can see that they have an earnings per share of 9.4%, and Caterpillar pays out just $4.12. So they have a very low payout ratio. Looks like that's the payout ratio for your average payout. Yeah, about 59%. If we look at AT&T, 63% is what it's showing here. JP Morgan's 32%, very nice. And Pfizer is 51%. So all four of those are actually really well. So I would say that if we were looking at revenue as a big factor, Pfizer would look a little bit scary. What's the whole point with decreasing revenue? AT&T stock price, if you're in it for appreciation, AT&T would not be the one you'd want to buy. JP Morgan has the potential to cut their dividend in the future if you add it into your portfolio and it just kind of cuts it in the future. Due to regulations, they could do that, but it does have strong capital appreciation on it if you're looking for that. And Caterpillar there, just a solid pick if you're just investing for the long term. And it's one of the few companies in that whole sector there, so kind of an interesting one. Now, of these ones, the worst performer here is JP Morgan, down 16.67%. And while I said I would not buy more of it, it's not a bad company. What I am going to do today is actually kind of split it up. I'm going to go ahead and just buy all these positions are kind of in the same range. Pfizer down 12, and my worst one here is JP Morgan down 16. So really not too big of a difference there, but I'm going to be focusing on Pfizer and continue to buy more of AT&T. Okay, so let's go ahead and jump back over to the M1 Finance platform, and let's go ahead and locate Pfizer right there. and we have $55.22 in the account. Divide that by 2. That's roughly $27.61. So let's go ahead, hit buy sell, and select buy. Make sure that's selected. $27.61. Going to leave us $27.61 for our AT&T buy. So we're going to go ahead and select Pfizer and select T for AT&T. And we'll do the remainder here of 27.61 and continue and confirm. And in the meantime, I am going to look into Pfizer. Why has it, what's with the revenue being decreasing? It's not going to stop me from investing in it. I know in the short term, Pfizer is a great company. Regardless if I do the research, I've already done the research in the past. I know why I added it to my portfolio in the first place. I'm not going to judge myself in the past for adding it in there. And that is basically the two companies here that we're buying today, AT&T and Pfizer. While I do think that both JP Morgan and Caterpillar are really great buys, I think JP Morgan does have more downside potential here in the short term versus where it's at. I could see it dropping. Let's look at the 1 year period here. I could see it dropping here back down to say maybe $80. Where was JP Morgan in the downfall of March? $76. So, we're at $92. Rates are falling. The stock market is having a bit of some weakness here. JP Morgan lost 5.34% last week alone. I could see this company falling, say, into the 80s or even back into the 70s here if the market, has a lot of fear driven within it. Caterpillar, on the other hand, let's go ahead and take a look at Caterpillar really quick. What's its 52-week low? Caterpillar is at $87.50. That's really crazy. So $87.50. So I feel pretty confident in both Pfizer and AT&T. Here, Pfizer has a little downside down at $27.88, and AT&T, we already saw that one. That's just a few dollars off at 26 versus 29. So $3 there, and looks like maybe 5, maybe a little less than 5. So $4 and some change for Pfizer on those positions. And that's it. So that is going to be it for today's video. Let me know in the comment section below, what stocks are you buying? What do you think of my two stock picks between AT&T, Pfizer, JP Morgan, and Caterpillar? Which two would you have chose if you had to pick one? Let's just say if you had to pick one, which one would you have bought? Let me know down in the comment section below. And of course, if you have not yet subscribed, would really appreciate it if you do head down there below, hit that red button, subscribe to the channel, hit the bell to be notified every time we go and release a new video. Give this video a thumbs up if you haven't done so already. And of course, that is it. Thank you all for tuning in. I will see you next time. Have a great day. Bye-bye.